Two people, same age, same salary, same starting point. One ends up with over $200,000. The other barely reaches $20,000. Same market, same opportunities. One decision created the gap. And the dangerous part is that decision feels small when you make it. It happens exactly when you feel this pressure in your chest. You open your portfolio. Red, again. You check the news, worse. And suddenly doing nothing feels irresponsible. Like you should act, but you don't know how. This is where most people lose. Not when markets crash, but when emotions start making decisions that logic should make. Right now feels dangerous, but historically, this exact feeling creates opportunity. Not in calm markets, not when everything is clear, but inside confusion, inside fear. Over the last 100 years, markets were positive in over 94% of 10-year periods, and in 100% of 20-year periods. Every crash, every crisis ended the same way: recovery, growth. But most people don't benefit from that. Because this isn't a market problem, it's a behavior problem. Your brain is wired against doing the right thing here. Let's break it down. There are four forces controlling what you feel right now. Uncertainty. When you don't know what happens next, your brain assumes the worst. Loss aversion. Losing money feels twice as painful as gaining it. Social proof. Everyone is scared, so it feels correct to follow. Time distortion. Short-term fear feels permanent. These forces don't guide your decisions. They override them. That's why smart people still make bad financial moves. Over 30 years, the market returned around 10% annually. The average investor, less than 4%. That gap isn't strategy, it's behavior. Now let's make it real. Meet Mark, 27. Normal job. Checks his portfolio every morning. He just started investing. $5,000 saved, $500 every month. Now Alex, same age, same income, same plan. From the outside, identical. Until the market drops. At first minus 10%, then 20%, then 30%. Headlines turn negative. Crisis, recession. Mark feels pressure instantly. That need to act. He starts checking more often. Refresh, refresh, refresh. At night, phone glowing in the dark, scrolling endlessly, trying to understand what's happening. But here's the truth. Information doesn't reduce fear and uncertainty. It amplifies it. Because every headline adds doubt. So Mark makes a decision. He moves to cash, just until things feel safe. It feels smart, responsible, controlled. And most importantly, it feels like relief. Your brain rewards relief, not long-term results. Now Alex. Same fear, same uncertainty, but different behavior. He keeps investing, $500 every month. Even when it feels wrong, especially when it feels wrong. This is not confidence, this is discipline. Confidence needs certainty. Discipline works without it. Now watch what happens. The market drops 30%. Your money now buys 43% more shares. At a 40% drop, you get 67% more. You're not losing opportunity. You're increasing ownership. But it doesn't feel like that. Because your brain sees red, not value. Months pass. The news slowly changes tone. The market stabilizes and quietly starts rising. But Mark is still waiting. Waiting for safety. Waiting for certainty. And by the time it feels safe, the opportunity is already gone. This is the part nobody talks about because it's uncomfortable to admit. The moment things finally start to feel safe is almost never the moment when opportunity still exists. Because markets don't wait for your emotions to catch up. They move based on expectations, not comfort. And by the time your brain says, now it's okay, the best prices are already gone. Now Mark is watching the market go up. At first, he doesn't believe it. It looks like a temporary bounce, the kind he has already seen during the drop. But days pass, then weeks, and the movement continues. Slowly at first, then with more confidence. And something shifts inside him. The fear that once protected him disappears and gets replaced by something much heavier: regret. That quiet, uncomfortable realization: I might have made the wrong decision. And this is where the second mistake happens. And it's often more expensive than the first. Because now decisions are no longer driven by fear, but by the need to fix what already happened. Mark goes back into the market, but not with a plan, not with discipline. He goes back in emotionally, trying to recover what he feels he lost. But the prices are higher now. Exactly where he sold is now cheaper than where he buys. And this creates a hidden loss that most people never fully notice. It's not just bad timing, it's a full cycle. Sell low, buy high, repeat. Now look at Alex. He didn't make a brilliant move. He didn't predict the bottom or analyze headlines perfectly. He simply continued his process, investing every month regardless of how it felt. Through fear, through doubt, through discomfort. And this is where the real difference starts to build. Not in intelligence, not in knowledge, but in consistency under pressure. Here's the math behind what actually happens. If you invest $10,000 and leave it for 20 years, it grows to roughly $65,000 at historical averages. But if you miss just the 10 best days in that entire period, your result drops by more than half. Miss 30 of those days and you're barely keeping up with inflation. And here's the part that makes this even more uncomfortable. Those best days almost never happen when things feel good. Over 70% of them occur during crashes or immediately after. In other words, the moments that build most of your wealth happen when you least want to be invested. And if you step out during those periods, even briefly, you remove yourself from the most important part of the entire cycle. That's why timing the market doesn't just fail. It actively works against you. Now, look at the long-term outcome. Same starting point, $5,000 and $500 every month. No difference in opportunity, no difference in resources. But Mark, who moved in and out, ends up around $20,000 to $30,000. Sometimes more, sometimes less, but without meaningful compounding. Alex, who stayed consistent, crosses $200,000, often much higher depending on the period. Same inputs, completely different outputs. And the only variable that changed was behavior. This is what makes investing uncomfortable. Because the correct actions rarely feel correct in the moment. They feel uncertain, slow, and sometimes even wrong, while the wrong actions feel safe, controlled, and logical. That inversion is the trap. Now, bring this back to you. Right now, in this exact moment, you're likely having a similar internal conversation. Maybe I should wait a little longer. Maybe things will become clearer soon. And that thought feels reasonable because it reduces tension. It gives you a sense of control in a situation that feels unpredictable. But in reality, that feeling is not protection. It's delay. And delay in investing has a very real cost. Not immediately, not visibly. But over time, it compounds just like returns do. Years from now, you won't remember this exact moment or the headlines that made you hesitate. But you will live with the outcome of the decision you made here. So the question is not what the market will do next. The question is how you will respond to uncertainty, because your response, not the market, determines your result. The strategy itself is simple. Continue investing on a consistent schedule. Avoid trying to predict short-term movements. Focus on ownership, not price fluctuations. And most importantly, understand that discomfort is not a signal to stop. In many cases, it's the signal that you're in the right place. This is not motivation. This is math. And math works the same way whether you feel confident or afraid. Now, everything comes down to one decision. Not in the future, but immediately after this moment. You will either wait, delay, and try to feel safer, or you will act with a system that doesn't depend on how you feel. Because 10 years from now, the fear will be gone. The headlines will be forgotten. But one thing will remain, the result of what you decided to do when it mattered. And that difference is everything.